So right now, China's having a 1929 moment, or maybe a 1989 moment. Here's what I mean by that. You may be familiar with the US stock market collapse of 1929. Waves of speculation and margin trading led to a devastating collapse, which led to a depression, the really great one. In China last year, the government started urging its people to invest, so people started buying stocks in a big way, and often on margin, which means with borrowed money. And the Chinese stock market shot up. Margin trading allows investors to take huge risks for big returns, but it also introduces a ton of volatility into the market. It also happens that the vast majority of Chinese investors are individuals rather than large institutions, which is the opposite of how it is in the US and other developed economies. This adds even more volatility to China's stock market because it means there's a herd mentality as people rush to move their money in and out of stocks, sometimes all at once. So in China, over the last year, you have lots of margin trading, an investing herd mentality, and a rapidly rising stock market as a result. Sound familiar? Chinese stocks started tumbling just under a month ago, and its market went into free fall. But you could also say that this is less 1929 and more like Japan in 1989. Remember in the 80s how Japan was this major economic juggernaut that everyone thought was about to unseat the US? And then all of a sudden, it wasn't? The short version of what happened is this. Japan in the late 80s, like China today, had a slowing economy. To stave that off, it made borrowing super cheap. So companies borrowed like crazy. But their businesses weren't growing much. Remember, slow economy. So they invested in the stock market instead. Stocks went up. And more stock profits meant even more money to invest. Stocks soared. And then, all of a sudden, they crashed. Like they're doing now in China. But what's really interesting about this 1929, 1989 thing is what it tells us about what might happen next in China. In 1929, the US government didn't really do much to protect people and businesses from the crisis that followed the crash. Banks failed. Families and companies lost everything. And the country struggled to free itself from debt for a very long time, something that we now call the Great Depression. Japan's government wasn't going to make the same mistake, so instead it made a different one. It threw all the money it could into preventing banks from failing and companies from going under. But by preventing weak companies and banks from going under and ignoring the debt, Japan let an enormous amount of debt pile up, weakening its entire economy. And just like that, the Japanese growth miracle was over. America's reckoning with debt was brutal, but it eventually ended. Japan, not so much. It's still stuck in neutral 25 years later. So what's that have to do with China? Well, just like in 1929 America and 1989 Japan, China's wildly swinging stock market is a symptom of a much bigger and much graver problem. It has way too much debt. The Chinese government's been intervening almost daily to try to boost the market. So the question is, in trying to avoid being 1929 America, is China turning into 1989 Japan instead?